Okay, so let's start. Okay, first of all, I think most of the people in the audience know me already, right? My name is Brenda, and I'm from Impact Taxation and Financial Services. So we're an accounting practice based in Bankstown area. So in this seminar, mainly we'll introduce 10 things you should consider before buying a property. So on my side, I'm focusing on the tax and planning side. Okay, but later on, we're going to pass to Richard. So Richard is from TDI Legal from Bankstown, and he has more than 20 years, right, Richard? More than 20 years experience. And then he also prepared 10 things you should consider before buying property on the legal side. So I actually had a look at the content, and I think it's packed with valuable information as well. So Richard, would you like to say a couple of things?
No, thanks for having me.
No,
You're showing
so
my age
later on.
again.
Yeah, okay. Maybe later on you can introduce yourself.
I might just, for the purpose of the meeting, just turn my camera off.
Yeah, no problem.
I'll let you run the show, and then I'll come and join you back in.
Okay, no problem.
When you're ready.
Okay, we'll talk to you later then.
If you want to ask anything during the obviously the seminar, just let me know, and I'll pop my mic back on.
Okay, no problem. No problem.
Right, thanks,
that's cool.
Bruno.
Yeah. Okay. Thank you. All right. That's perfect. So let me just minimize the camera side. Okay, let's start. So let me maximize my screen first. Okay, so 10 things to consider before buying a rental property. So before we start to the main content, this seminar is for general information only. So before making any decisions, you still need to contact us, contact your own experienced tax agent to get the advice. And then also during the seminar, we're going to leave some time for you to ask questions. But when you're asking a question, be careful, don't give us any of your confidential information, because we're going to upload this recording to YouTube. All right. Okay, that's good. And then let's see what I can make it bigger. Okay, so a lot of people don't know the issue, within with Australian tax system is very complicated. It's actually one of the most complicated system in the world. And then sometimes just by simply not knowing your choices, you might be losing tens of thousands of dollars. Yeah, we'll give you some examples later on. So basically the important part is you need to know your choices. So you don't have to understand the details of how to apply the law, but knowing your choices, and then you can find a good professional to ask the right questions. That's really important. And then also you need to act before buying or selling. Okay, talk to a good tax accountant, a good financial planner, or good legal personnel to understand all the possible choices and how to utilize them. Sometimes, especially with tax planning, when you it happened to a lot of our clients, actually, when they come to us, it's already too late. All right. Okay, sorry. Oh, let me admit more people in. I just noticed people are coming in. Okay. All right. So the first question, big question you need to ask yourself is, how should you set up your loan structure? So this is something a lot of people don't know. Yeah, sometimes I talk to people from mortgage broker background or lending managers. Most of them know if they're experienced. Yeah, but this is not common knowledge. So if you have an offset account, you can actually pay directly to the offset account. But if you don't, and when you pay directly to your loan account, you actually lose the interest deduction on that part you paid to the loan. Okay, so it sounds a little bit complicated. So let's illustrate with an example. So let's say Matt Smith has a loan balance of 800K for his rental property. He received an inheritance of 600K. Since he didn't have an offset account, also his bank offered redraw facility. So he just paid everything to his loan account. And then after payment, he only had a loan balance of 200K. So from this moment, the maximum interest he can claim will be on this loan balance only. Okay, so that happens even if he redraw money out from his account. So basically that balance is frozen. All right. And then, but on the other side, if he did have an offset account, he could have deposited the money to the offset account. And then when he redraw the money from the offset account, he can claim the interest deduction on the full balance of the loan. Does that make sense? Yeah. So the tax office is doing that. Basically, you need to be able to draw a line between private and non-private. Okay. So when the loan is 100% related to an investment, so that means it's 100% to be used to generate income. Okay, then you can claim 100%. But let's say if you pay back to the loan and you redraw, that redraw, if it's actually for private purpose, then you lose the deduction because it's for different or private purpose. Okay, but if you have offset accounts, you're basically drawing a line in the middle. Then it doesn't matter when or how you want to spend the money when you redraw from the offset account. All right. So we'll give everyone a chance to ask questions in the middle. Yeah, after I go through maybe point 5. Okay. So then the loan structure could also help you to stabilize interest and speed up loan repayment. So why is that? So let's have a look at the example again. So Matt Smith has a loan balance of 500K for his property. He's confident that he can pay off 150K in 3 years. Okay, so he actually set up 2 loan accounts, one standard variable with an offset account, one fixed rate account for 3 years. After the loan accounts were set up, Matt informed his employer to change his pay to be deposited directly to the loan offset account. So the benefits of doing that is when the interest rate goes up, there will be no impact to Matt's fixed rate loan accounts. All right. So it's probably happening right now, actually. Yeah. So if people were smart enough to have a part of their loan as fixed rate account, like say last year or a couple of years ago, then they would still be benefiting from it. Yeah. Okay. And then when the interest rate comes down, Matt is benefiting part of it on his standard variable account. Okay, that's quite obvious. Okay, then by depositing his salary directly to the loan offset account, it will help Matt to save his interest as soon as his pay hit the bank account. Okay, it will start helping Matt to save his interest right away as soon as that money arrives the offset account. All right. Okay, so then let's continue. Okay, this point is really important too. Yeah, a lot of people don't know. The timing of renovation is really important when you purchase a property or a rental property. So it happens to a lot of people once they buy a property, they will do a lot of repair, maintenance, renovation to it. Then they get a tenant or start advertising for it. But the issue here is from the renovation cost, if there's a part of genuine repair maintenance. So genuine repair maintenance is more when you're patching up or when you're repairing a part of the property. So let's say, for an example, if you have wooden floor for the property and then a couple of floorboards might be broken, then you can replace the floorboards. That's actually repair maintenance. But if you replace the whole unit, so all the floorboards, that's actually a capital investment. Yeah, so that's very important. But genuine repair maintenance can also cost people a lot of money. When you think about it, if you have a broken part of the fence, yeah, what if you have a big hole on the concrete driveway, then you need to repair it, then that could be costing you a lot. So that repair maintenance, if you do it after once the property is available for rental, okay, then you can claim an outright deduction against rental income within the same tax year. So this is important. But if in case you do it before when the property is available for rental, you have to postpone the cost. Hello? Does anyone have a question? Oh, that's okay. Yeah, maybe you just need to mute yourself. Yeah. So, but when the property is not available for rental yet, okay, so that cost, it will be combined to your initial purchase cost. And then you can only claim the deduction when you are selling the property in the future. So as a part of the cost base, when you are calculating capital gains tax. So you don't know how many years that will take. Sometimes people take 20, 30 years to claim the deduction. Does that make sense? So there will be a major delay when on the time you can claim it back. And then also another issue is the amount of deduction is halved. Okay, we'll go back to it again. Yeah. So when we're holding the property for 12 months, for more than 12 months, we actually receive a 50% capital gains tax discount. So basically, that also not only you can't claim it upfront. So when you claim in the future, the deduction is actually halved because of the 50% capital gains tax discount. Yeah, so you're losing a part of the deduction itself as well. Okay. So that's on the timing of the renovation or repair maintenance. Oh, one thing I forgot to mention, I actually highlighted here. One is available for rental. So available for rental, it doesn't necessarily mean that you do have a tenant living in there. So available rental can be the date you have put in as the advertisement date. So you advertise to say, okay, this property is available for rental from 15th of November. Even if on 15th of November, you don't have a tenant yet, but that's the date you have advertised that the property is available for rental. Okay, so from that date, if you have genuine repair maintenance for the property, then you can claim an outright deduction, okay, against rental income. All right. Okay. So then let's go to point 3. How should you split ownership? This is actually quite a common question. Yeah, from most often happen to a couple. First thing we need to know, okay, for tax purposes, the percentage of ownership is based on the legal title. Okay, this is really important, regardless of who is paying more on the mortgage. Okay, this is a common misconception. People feel, okay, if the husband is paying more, then the husband can claim more ownership. It's not the case. Okay, then tax profit on the rental. Okay, if it's a profit, you might want to allocate more ownership to the low income earner to utilize a low marginal tax rate. That's quite obvious. Okay, if it's a tax loss, you might want to allocate more ownership to the high income earner. Okay, so that the loss can help the high income earner to reduce the tax and receive a better refund. Okay, so the ultimate goal is the family should work together to pay minimum tax. So that's the ultimate goal. Of course, there are other considerations, say family trust, okay, or other structures. So family trust is probably one of the structures people use a lot to help a family to reduce overall tax. Okay, so there are some recent changes on the tax law or profit distribution for family trust. Is on 100A, the new tax law changes. But that we wouldn't draw in more details into that, but still it doesn't change the fact that family trust is a very good structure to help us to reduce tax for the family income, because it's just from the fact that we can even out our income, just distribute. We can pick and choose the family members and distribute to them. Okay, so that's the reason why we can achieve a lot of tax savings. Yeah, and then also family trust will help with asset protection. Yeah, but this is a more complicated area. And then it's also easier succession. Yeah, so if you are planning for, say, succession planning, it's easier for parents to pass down the family wealth to their children, yeah, if you're within the trust structure. And then the downside of it is the loss. So let's say if you have rental loss, the loss can't be distributed, you'll be trapped within the trust. Okay. So then also to establish a family trust and ongoing operation, the cost could be quite high. All right, that's another downside. And then also you need to pay land tax. Okay, in different states, yeah, they tend to charge a lot more to family trust, yeah, on land tax compared to individual ownership. And then also, if in case you don't distribute anything, or there are still profits left within the trust, you actually pay the top marginal tax rate, which is penalizing. Okay. Also, high tax for minors. So minors, if someone is below 18 years old, if you want to distribute to that person anything above 416, it's actually not worthwhile because it's more than the top marginal tax rate. Okay, so that's the major downside. And then, okay, point 5. When we plan our initial ownership, either utilizing family trust or different structures, we also need to consider whether the income level will change, for different owners. All right. So if, say, for example, if husband wife team, maybe they plan to have a baby, all right, 2-3 years time, how many years will the wife be staying at home to look after the baby? And then that's also need to be included in the consideration, all right, in your analysis to consider how should I split the ownership. Okay. Then also sometimes the rental income might change to loss, okay, or loss change to profit. And then should you change it then? Okay, or consider, should I change my ownership? Consider the changes. All right. Okay, so that's 5 points already. So let's have a look whether anyone has any questions. So you can either add a question to chat box, or you can just raise your hand and or you can just unmute your microphone and speak to me.
Hi, Brenda.
Okay. Hi.
Hi. Yeah, with regards to point number 3.
Yeah.
If the legal title is 100% owned by the husband, and then the mortgage is actually 50-50, how will that impact the deductions?
Oh, it will be 100% to the husband.
Ah, right. It doesn't matter whether the loan is under both names.
That's right.
Okay. Thank
That's
you.
right. Yeah. So it's based on the legal ownership.
Okay. All good. Are you okay now?
Oh yeah, I'm okay. I'm just gonna send this. Yeah, I was just thinking there's no new application form. There was no new application form. You know what I mean? But I think when I click on the link, it.
Oh, sorry. Is that a question? I was trying to. Okay. Are there more questions? Or you can add your question to the chat box too. Okay. So if nobody have questions, we'll just continue. You can always come back to me to give us a call or send me an email. Oh, we have a question from the chat box. Okay, if you have an existing property with a bank loan, 100% to the government, it's possible to rearrange the ownership of the property between husband and wife? That's a very good question. Okay, so you can, but you will incur transfer cost. The transfer cost will include the if it's a rental property, say capital gains tax, stamp duty. All right, then probably you need to pay legal costs as well to conveyancer if you want to change the owner, the legal title. Yeah, so transfer cost is something you need to consider too. And then we're going to show you in a later slide, on the possible future considerations, because sometimes if you set it up incorrectly, you can still change. Yeah, don't be afraid to change it. Yeah, but the main thing is you need to understand your cost. So what's going to be the cost or benefit? If it's more beneficial to change, you should always change it. But the main thing is you need to do that calculation or to find a good professional to help you with the calculation to understand. All right. Does that help to answer your question? Okay, Richard has a question. there's a stamp duty exemption, which will apply for the transfer of 50% of the property to a spouse for an owner. That's correct. For an owner occupied property. So for main residents, okay, main residents have a lot of exemptions. So not only for capital gains tax, stamp duty. So basically, that's actually following in main residence. So when you are changing the ownership of a rental property, there's no exemption. Yes, so generally for rental property, there's no exemption for stamp duty. Yeah. All right, that's cool. So let's continue. You can send me, at the end of my part, you still have more chance to ask questions. So let's go to point number 6. Okay. Okay, so point number 6. Can you treat your rental property as main residence and claim capital gains tax exemption? Okay, the answer is yes, provided if you're meeting the requirement. Okay, so generally speaking, main residence is exempt from capital gains tax. Okay, so when you stop living in it, then this actually stops. But if you, let's say if you leave it vacant, you don't rent it out, you don't live in there, you can potentially elect to treat that property as your main residence forever. Okay, but let's say if you rent it out, but the criteria is you need to live in there before. So this is a very important part. Every year we receive a few clients who didn't know about this, and they actually pay tens of thousands of dollars to tax office on the capital gains tax. But if they actually talk to us before they purchase property, they didn't have to pay $1. Yeah, so this is important. So it means that if you buy a rental property or you buy a property and initially you actually live in there for 6 months and then you move out, provided if that period you rent it out is below 6 years, okay, then you can elect to treat that property as your main residence and then to claim a capital gains tax exemption. All right, so but here, okay, I actually highlight this part in bold. You need to have used it as your main residence first. So at the very beginning. Also, you have to stop living in there because sometimes people rent part of their house. Okay, they're saying, oh, can I still treat it? You can't. Yeah, you have to stop living in there altogether. And then the whole property is rented out to someone else. Okay, then also at any point of time, you can only treat one property as your main residence. Unless you're moving, yeah, when you're moving in between buying and selling, for a 6 months window, you can treat both properties as your main residence. But that's kind of a separate topic. Yeah, but if you're interested, let me know. I can help you to understand. Okay, so then we also need to understand on what occasions tax office allow us to treat a property as main residence. Okay, so this is important as well. Okay, so there are 5 different criteria. You and your family live in it. Your personal belongings are in the property. Okay, it's the address your mail is delivered to. Okay, for your electoral roll, your address is left there. And services, gas, water, power, that's connected. Okay, so when you're making the requirement, then you can treat that property as your main residence. So let's focus on the first 6 months. Okay, and then at any point of time, you can only treat one property as your main residence. So I'm going to illustrate as an example here, because it's going to be more clear how you can select one property as your main residence. Okay, so let's say Lizzie bought a property in Bankstown, okay, on the 1st of January 2015 for $400K. That's including all costs. Let's pretend that's all costs inclusive. She lived there for 6 months, then bought another property in Bondi for $500K, and then she moved in there. Okay, so see, she lived there for 6 months for that Bankstown property, so she's meeting the criteria from the very beginning. Okay, then 5 years later, on the 1st of January 2020, she sold the Bankstown property for $550K. She applied the main residence exemption and didn't have to pay tax on the capital gain of $150K. All right, and then when she sells her boundary property in the future for the period she already used for the CGT exemption, so the period is from the 1st of January 2015 to the 1st of January 2020, she will need to pay capital gains tax. Okay, so capital gains tax is calculated on the proportion. So if we drill down to more detail, it's actually based on days. So how many days? If you own the property for 1,000 days, and then for 200 days, you have to pay capital gains tax, and that's like 20% at the end. Yeah, you have to pay, calculate on the capital gains tax. All right. So then, okay, then we'll finish this one. Okay, then the important part, okay, critical planning opportunities. So before you sell a property, let's say even if you have 2 or 3 properties, you need to have a look. So before you sell one of them, okay, which one can I trade or potentially elect to trade that property as my main residence? Okay, then you need to choose the one that will give you the most capital gain for exemption. So if you have 3 properties and then if they're all ticking the boxes, okay, all meeting the requirement, then you need to consider which one. Yeah, if one of them you're going to generate a capital gain for 200K, the other one is 300K. Of course, always choose the one with 300K. You elect that property to be your main residence because you're going to save more tax. Okay, so let's continue to 2.7. Okay, you also need to decide whether you need to purchase a depreciation report. So this is a lot of people don't know about this one as well, because for the depreciation we claim, the building part, okay, building depreciation, in accounting terms we call it capital works. Okay, for that portion, when you are selling the property in the future, they need to be added back to pay capital gains tax. Okay, so even though every year you claim a deduction against rental income, but later on you need to add back. So again, let's illustrate with an example. Okay, John has an annual salary of 250K. His marginal tax rate is 47%, including Medicare levy. So based on his depreciation report, he can claim $10,000 deduction on depreciation each year. So his tax saving on the deduction will be $4,700. Okay, so it's basically just the depreciation multiplied by his marginal tax rate. Okay, so every year he'll be saving this much. And then when the property is sold, provided if he has held the property for more than 12 months, he will receive a 50% discount on his capital gain. Okay, so then when this $10,000 is added back, the tax payable will be $10,000 multiplied by the marginal tax rate, multiplied by the 50% discount, and then it's $2,350. All right, so then he's better off by $2,300.50 each year because he can claim the deduction every year on 47%. And then when he add it back, he actually using, it's almost like half of the marginal tax rate. It's actually 23.5%, okay, to pay capital gains tax in the future. So depreciation report is definitely ideal for a high income earner. Does that make sense? Yeah, because you pay on the full marginal tax rate, but at the end, you claim a deduction on the full marginal tax rate upfront. At the end, you only pay half of your marginal tax rate when you're paying capital gains tax. Okay, but let's have a look at another example. What if the person's income is actually quite low? Then, okay, so let's say Erica. Erica has an income of $25,200. So her marginal tax rate is 19% for the portion of her. So for the portion of her income above $18,200, yeah, because $18,200 is actually the tax-free threshold. So based on her depreciation report, she can claim $10,000 deduction on the depreciation. Okay, so $10,000, but the part she can utilize is only $7,000. So that's above the tax-free threshold. So her tax saving will be $1,300. Okay, $1,330. Okay, then when the property is sold, the capital gain okay, including the capital gain, her taxable income in the year when the property is sold is increased to 150K. So with a marginal tax rate of 39%. So that's including Medicare levy as well. So the capital gains tax on adding back the $10,000 will be $10,000 multiplied by 39% multiplied by the 50% capital gains tax discount equals to 1,850. All right, so every year Erica is actually worse off. So by getting the depreciation, she's worse off by $520. All right, does that make sense? So it's actually not worthwhile for her to purchase a depreciation report. Okay, so then in reality, it's actually more complicated. Oh, sorry, George, I'll come back to you later. Yeah, let me finish this point, then I'll combine everyone's question together. Okay, so in reality, when we think about it, the real situation is more complicated. Yeah, because sometimes husband and wife might own a property together. You know, husband high income, wife might be low income, and then or even earning nothing. Okay, so then should the couple purchase a depreciation report? All right, so that's a question we need to find out. And then so basically we need to find out. So depreciation report it should be a factor you need to consider how you should split the ownership. Okay, and then if you use the family trust structure to make the purchase, it's even more complicated because how many family members you're going to include and what's going to be their income and marginal tax rate. All right, that's also need to be included in your consideration. Yeah, so it's actually a bit complicated, but later on I'll show you a solution. Okay, there is a solution at the end. Okay, so let's continue. All right, Centrelink payments. That's something not many people will think or consider. Okay, so because a lot of Centrelink payments are income asset tested. Okay, so if you attach a part of the rental ownership to a family member, and if that person is planning, yeah, or is already receiving Centrelink benefits, do you know whether that will impact on the Centrelink payments? Okay, one key example for age pension, yeah, because if you're say if someone's eligible now, and then but if the person is included in a trust structure, yeah, this actually happened to quite a few of our clients too. We had to do major trust deed amendment to remove some key personnel from a family trust. Yeah, because once you include someone as a appointee or say trustee director in a family trust position, okay, then the government, when they're evaluating whether that person can receive age pension, the trust asset will be included in the consideration as well. And then let's say if someone is based on the age or without the trust asset might be eligible now, but the government will reject the application, yeah, if the asset is too big, yeah, to meet the government requirements, then that person have to wait for 5 years. Yeah, so it happened a few times. We help someone to change the whole trust deed or to do the trust amendment, but the person still have to wait for 5 years. So imagine how much this person is losing, yeah, from 5 years pension. So this is something not many people consider, but you could potentially lose a lot. Okay, so then okay, also when you're distributing trust a profit, that should be something you need to consider too. I'm not saying that you shouldn't, because this is also a mistake a lot of people make. They feel, okay, one of my family members is receiving government pension, so I shouldn't allocate any family trust to the person. But it's actually not the case, because I think the important part is still consider cost benefit. So what's going to be the cost? What's going to be the benefit? We actually did like during a tax planning session, we actually helped a family to include and someone elderly who's receiving government pension into the distribution, and then they're actually saving more on tax compared to the government pension. So still, cost benefit analysis in scenarios like this is really important. Yeah, it's not like you can't do it. You can do it as long as you understand the benefits outweighs the cost. Okay, number 9. So self-managed super funds. yet it's actually getting more and more popular now. So the major downside, most people are focusing on the downside, okay, because you can't get the money out once it's locked in the self-managed super fund. And also the cost is quite high to set it up, complication on legal and compliance requirements. Okay, and the investment strategy, you actually need to review it from year to year or sometimes half yearly. And then the trustee has a lot of responsibilities to meet the government compliance requirements. But on the pro side, the benefits are, so the tax saving opportunity, this is something major, 15%. Okay, if you earn rental income, you only pay 15% for rental property. Okay, if you sell the property in the future, only 10% of capital gains tax, provided if you have held the property for more than 12 months. Okay, so because within the super environment, the capital gains tax discount is 1/3. Okay, so that means it's reducing from the tax rate from 15% to 10%. Okay, then you're actually controlling your own investment as well. Then also it's probably the best asset protection structure. Because no third-party creditors or even someone can claim bankruptcy. Okay, the third-party creditors, they can't touch the money in the super funds. Okay, so that's so it's probably one of the best asset protection structures. Also cost saving. This is something a lot of people don't know. If you use a normal retail super fund, you still pay 1% to 1.5%, okay, on your balance to the admin people. Okay, so if you have a retail super fund for say 200K, 300K, then the fees you're paying to an accountant or auditor for your annual return for the super fund is roughly the same. Okay, right. Then number 10, consider internal ownership changes. So that's actually, I think, a question someone asked earlier. What's going to be the cost to change it? So you can still change it, because I think it's still falling back to that what I mentioned on the cost of benefit. Okay, so if the benefit outweighs the cost, then it's always a better choice. Okay, so some of the considerations, okay, income level of the property owners changed. Okay, if someone's income drop or someone's income increase, husband-wife team, then you can consider changing. Or property might change, from tax profit or tax loss, or the other way around. And then, okay, some of the family members maybe plan to receive government benefit, then you need to consider removing that burden from your ownership structure. Okay, or maybe children, if you have children and who's going to be 18 years old very soon, then you might consider a family trust structure if you have a big rental profit. All right, so there are all the considerations. And then last but not the least, you need to combine all the strategies, okay, to achieve the best tax outcome. Of course, there's also Centrelink benefits. Okay, so dollar value, how much you're going to save for the family, combine every single thing, and then to see. All right, so then what I'll do is I'm going to show this final solution. Okay, so this is going to be our final solution for you. Okay, so let's say if you want to buy a rental property, so this needs to be done before you settle on the legal ownership. Okay, ideally, unless of course, if you want to change at a point of time, you want to change the ownership, you can also talk to us and we can help you with the calculation too. Okay, so for this couple, actually fake clients, okay, we have prepared this report. So they have selected 4 different scenarios on the ownership structure. Okay, so first one is 50-50, husband-wife ownership, and then 90-10. So 90 to the high income earner, 10 to the low income earner, or family trust, or self-managed super fund. Okay, then we actually help them to do a calculation, which structure is going to give them the best saving. So within the calculation, we included a few different factors. So of course, the tax saving on the rental, depreciation deduction on the from year to year, how much tax they can save, and also the final capital gains tax payment. Sorry, let me have a sip of water. I think I'm speaking too much. Okay, then we also included for the family trust structure, we have also included the ongoing cost, initial setup cost, also the land tax. Okay, so all the costs we have included in this calculation. Then at the end, based on this report, you can make your best decision. Okay, of course, one thing I have to mention is your decision shouldn't be only tax driven. Okay, the reason why I mentioned that there are also other considerations. Say, for example, maybe asset protection, succession planning, all right, maybe family trust structure. It doesn't help you to save tax, but it can help you with asset protection, or it's going to be easier for you to pass your wealth to your children. Then that might be still an ideal structure. Does that make sense? But the important part is you're making an informed decision. Okay, if you're choosing a family trust structure, say, for example, using this example here, you know how much you're losing compared to other structures. So that's the main thing. All right. I think that's everything I want to mention in my part. Let me go to the question from George. Or anyone. Okay, I'll answer George's question first. So at what point would you classify someone as high income? Okay, that's a good question. So I think it's more based on individual circumstances. So high income, I think average income at the moment, if I'm not wrong, maybe say 75K in Australia. So, but I think high income is more comparative, or look at your marginal tax rate. So let's say a husband-wife team, maybe the husband is earning 75K, the wife is earning nothing.
Sure, cool.
Did someone have a question? Or would you be able to mute your microphone? Oh, that's okay. Yeah, so it's more comparative. So if, say, even if the husband is earning a medium level salary, but the wife is not earning a lot, then you still want to give more rental loss to the husband. Does that make sense? Does that help you to answer your question, George? All right, does anyone else have any other questions? So now is the question time for my part.
Hi, Brenda. Sorry, if I can just add to my question from earlier. I was asking more around in relation to depreciation calculation when you gave those two examples of the high income earner and the low income earner, and how the low income earner was actually worth off after calculating the depreciation.
Oh, I see.
So in that scenario, when does it actually become a net positive exercise for somebody? What tax rate or what amount do you need to be earning for that component to become a positive rather than a negative?
Oh, I see what you mean. So that actually also will involve calculation. Yeah, but I'll give you one example. If I go to the marginal tax rate table, if we look at the individual tax rates, because remember, one key thing we need to remember is at the end, when we're paying capital gains tax, it's actually halved our marginal tax rate. So the maximum we pay on the capital gains tax is actually 23.5%, including Medicare levy. Does that make sense? So that means if at the very beginning, so it's very possible the capital gain might bring you over to the top. At the end, when you're selling the property, it depends on how much capital gain you will generate. But the maximum you'll be saving or you'll be adding back is 23.5%, which is half of 47%. Does that make sense? And then when you look at before, see if your income level is between 45 to 120K, this is actually the most common range. Okay, then your marginal tax is actually 32.5%. Then of course it's going to be ideal for you. Does that make sense? Because let's say at the very beginning, you're claiming back 32.5%, or actually 34.5%, including Medicare levy. Then at the end, when you're adding it back, the worst case scenario, even if you're going back to 180K and over in the year you're selling the property, your tax rate on paying the capital gains tax, the maximum you pay is 23.5%. Does that help to answer your question?
Yeah, no, that's good. Thank you.
Yeah, all right. So it's, of course, you need to have a look at your individual situation. Yeah, but sometimes it's more complicated if it's a joint ownership, between high income and low income. Then you need to do a calculation to see, what's going to be the best split. All right, let me go back to chat. I think I got more questions here. Okay, that's from Danny. Regarding to renovation cost deduction for investment property, if we repainted the whole house, can we make deduction from the investment income? That's a good question, Danny. The answer, unfortunately, is actually no. Yeah, because if you repaint the whole house, that's actually need to be treated as a whole unit. Okay, if you on the other side, let's say if you have a hole on the wall, then you patch it up and then you only paint that area, that's actually a general repair and maintenance. Okay, if you're changing the whole unit, you're doing something like you're changing the whole kitchen. Okay, or you're painting the whole house, not only a part of it, then that's actually classified as a capital investment. Does that make sense? Yeah, if the total cost is about $300. Does that help to answer your question, Danny?
Yeah, thanks, Brenda. It's answering my question, but can we say, with the bill, can we separate the bills, say partially for the whole, or to make a small maintenance for the painting, but the remaining possibly it's for the whole house? Can we split the invoice in order to get deduction?
Oh, that's another good question. Yeah, the issue is, let's say if you patch it up, let's say you use blue color to paint the house. So because you have a hole or have somewhere, and then you patch it in blue color, then you actually extended the whole house, then that still needs to be treated as a whole unit. So it's a little bit like you start from repair maintenance, but then you change the whole unit. Then at the end, it's still the whole unit. But some other examples, if they need to be separate expense. Let's say, for example, if you have a hole in the driveway outside, then you pay a bill to get concrete in to patch it up. That's actually repair maintenance. Okay, then on the other side, you replace the whole fence. So the whole fence is actually a whole unit. Then that needs to be treated as a whole unit and capital investment. Does that make sense? Yeah, so we need to focus on your expense. So that one bill you're paying, is that just to patch it up, or genuine? Is that definitely a genuine repair maintenance, or is that changing the whole unit at the end? Yeah, even though it started from repairing. Does that make sense?
Yes, makes sense. But sounds like quite difficult to differentiate if we are not professional accountants.
Yeah. That's true. That's true. Yeah, I totally agree. That's why I think it's always worthwhile to find a good accountant to help you. Yeah, you can come. Yeah, maybe bring the invoices to us and tell us exactly what happened. Then we can help you with the decision.
Yeah, thank you.
Does that make sense?
Sorry.
All right.
Yeah, thank you.
Okay. I'm
Sorry,
just
I
going
have
to
another
answer.
question.
Yeah. I'm just going.
Yeah.
Oh. Yeah.
Sorry, I have another quick question.
Okay.
So regarding to the ownership change, for example, I forgot to put the first 6 months as an owner-occupied property, but later on, if I sell this property to my parents, can we still we need to pay the stamp duty, the capital gain tax, right? But
That's right.
regarding to the valuation, is there any way we can, minimize the current market valuation in order to get less capital increase if we transfer to our parents?
Oh, okay. That's actually need to be based on the valuer. So you need to find tax office authorized valuer. Yeah, it's better to, there are different ways of valuation. The best way with the best authority, I guess, is a valuer who can give you a report to say what's the market value at the point of sales. But that's a good question, because sometimes when people sell, they said, oh, we'll just say $1, we sold the property to a family member. But unfortunately, tax office will always ask us, how did you get the market rate? So even that happens when you transfer between family members. Okay, first get a valuation report, and then also if you didn't use that property for main residence, every other thing that's applied to when you're selling the rental property to a third party also applies when you're selling to a family member. So that's including capital gains tax, stamp duty. Does that make sense?
Yes, makes sense.
Yeah, but main residence, you will get a exemption. Yeah. All right, what I'll do, there are two more questions. I'm just going to answer them, then Richard can come in. Okay, so the first one is from Hu Hai. Hi, cooktop broken and switch out a new one. Can I claim the total cost for first reduction? Unfortunately, no. Sorry, Hu Hai, because that's actually I think kind of similar to Danny's question. If you start from something broken, if you actually call someone in to repair the cooktop, that cost will be genuine repair maintenance. Yeah, but if you actually replace the whole cooktop, okay, then if you get a new one, then the new one will become a capital unit. Okay, if you pay more $300, more than $300. Okay. Next question from Anna. Can we please get a copy of the PowerPoint? Yeah, no problem. Yeah, send me an email. Yeah, if anyone wants to get a copy of the slides, yeah, let me know, then I'll send it to you. Oh, sorry, there's another question from Li Tai. Does CTT exemption apply when you have two properties? Property one is being rented, but I plan to move back in. The second property is purely an investment. If I decide to move out of property one again, I rent on my own. Would property one be exempt from CTT if I move back in within 6 years? Actually, Li Tai, can you contact me after the seminar? Yeah, because we'll probably need to do a little bit more analysis. Yeah, so give me a call. We have, I'm going to upload the seminar to YouTube anyway, but my contact details is in the slide, if I can find it. Okay, so give me a call or send me an email. Yeah, or and then maybe we can organize a small session. I can help you with your question. Is that okay? Yeah, because it will be more complicated. All right, Richard, are you there? Are you there, Richard?
Yeah, I'm here.
All right, do you want to take over?
Yeah, I'll just try to share my screen.
Yeah, you should be able to share your screen now. Let me stop share first. Okay, perfect. I'm going to mute myself.
You can see the screen now?
Oh yeah, I can see your screen.
All right.
All right.
Thanks for that, Brenda. It's very insightful in terms of what to consider when purchasing property from a tax perspective. And again, a lot of insight as to your seminar. So thank you very much. I'm just going to briefly run through some things to consider from a legal point of view in terms of the process of purchasing, and obviously what to look out for. Some things to consider. So basically, I'll be just going through different stages of conveyance and what's involved, what to consider, and things to look out for. We'll touch on obviously finance, reviewing a contract, something that Brenda spoke about being the ownership structure, whether you're an individual or you're thinking of doing a corporate structure, a trust or an SMSF arrangement. We'll look at doing some pre-purchase inspections, signing your contract, considering any first home benefits that you may be eligible for, preparing for settlement, doing your final inspection, obviously then moving on to settlement of your property. So the first step I think everyone should really consider is obviously making sure you've got your finance approved. We're in a market where, you know, we just had a recent rate rise. Finance is a big item to consider at the moment. With every rate rise, you know, it is an impact on your financial capacity to purchase. So people are in the midst of working out what their capacity to borrow is. And obviously with every rate rise, their capacity reduces. So making that offer confidently at auction or to purchase a property when your borrowing capacity is somewhat fluid is a bit of a risk to take. So we encourage all our buyers, you know, make sure you consult with your broker or your banker to make sure that you've got your finance approved or at least pre-approved so you know what your capacity is to purchase. The other thing we need to consider obviously is the timing of how long the process will take. So back in the days, the good old days, you used to get approval within 5 days. We're now finding that time frame can push out to 10, 15 days. So having that conversation with your broker up front in terms of the timing, you know, most people are not prepared to finance when they find a property. You know, the brokers may need additional documents. They need tax returns. They need pay slips. You know, there are a few things that the broker will need from you to obviously get your finance approved, and with strict time limits involved in property, you want to make sure that you got your documents sorted out well before you make your offer to purchase. So getting in early, speaking to your broker, understanding the process and the timeframes will tend to avoid a lot of heartache during the call-off period, and also come to a settlement so that you're not missing out on your settlement period. Next is obviously getting your contract reviewed by a solicitor. So we can't stress the importance of getting someone to review your contract. Countless of times when contracts have sent us contracts, we've had a review of the contract and picked out some glaring issues from the beginning. You know, whether it be flood-prone areas, whether it be zoning issues, whether it would be, you know, potential illegal structures, easements, restriction of covenants. So there's a whole bunch of things that can be picked up very quickly before you actually commit to purchase a property. So have your contract sent to your solicitor. You know, the way that we operate is that we get clients to email us the contracts. It takes no more than 5-10 minutes to review it. We'll have a quick chat with the client and say, look, these are our initial reviews. There are things of concern. You know, these are the things you should look out for. And some people, when you raise those issues, well, they're red flags and they won't even bother with making the offer. Some are happy to consider still making the offer, but obviously considering that there are some issues that they may need to further canvass with maybe a town planner, maybe your architect, to see whether or not you can potentially develop on the property. So getting the contract reviewed as quick as possible is probably your best bet to save you some money down the track as well. The Latin term caveat emptor applies, which is let the buyer beware. So once you sign your contract, especially in auction conditions, you know, it's on you as the purchaser to make sure you've done all your inquiries, you've reviewed your contract, you've done your reports to make sure that, you know, what you're purchasing is what you want to end up receiving at the end. So get your contract reviewed as quick as possible so that you can avoid these issues sort of down the track. And as what Brenda touched about, you should also consider obviously your ownership structure. Ownership structure is very important to get right from the beginning. So whether you're purchasing as an individual or whether you're considering going the path of a trust or a company structure, getting it right from the beginning is very crucial. If you're purchasing as an individual, usually purchasing with your spouse, with your friends, there's two types of sort of structures as an individual. You talk about joint tenants and tenants in common. So one of the key differences relates to the type of ownership. So with a joint tenancy, we look at one share of a property which is jointly owned by 2 or more people. Usually it's 2 people, usually it's husband and wife, married couple, or some sort of partner that you may have, where all the joint owners collectively own that one share, and what's called the right of survivorship will apply. That is, if one of the joint tenants passes, then your property will be automatically vested into the surviving joint owner. Now, this is contrary to any intention you may put in your will. So if one husband says in his will, I want to leave my property to my sibling, he owns the property as joint tenant with his partner, and obviously the joint tenancy would override the will. So getting that right from the outset is also important for for estate matters as well, considering sort of the ownership structure that you have. So with most married couples, you'll find that it is the joint tenant option that they do consider. If it is incorrectly done, then obviously it'll be hard to undo on the passing of an individual. So joint tenancy is probably the most common when you come with spouse, but obviously people don't always buy with their spouse. You also consider obviously purchasing as tenants in common, where you may have friends who purchase together, you may have investors, you may even have a married couple who want to purchase with a differing share, as Brenda touched on, in terms of some sort of tax benefit. It may be an investment property where you may want to have the husband or the wife, the higher income earner, to earn the larger percentage of the property. So with the tenants in common, each owner owns a defined share in the property, depending on the percentage. So you may have 99.1%, you may have 50-50, you may have 40-60. So there's no fixed rule as to what the structure should be. But we definitely recommend consulting with your accountant to get a better understanding of what tax benefits and potentially liabilities that may arise with a differing structure. So you find people who are friends, people who contribute different amounts. So there may be friends who maybe contribute 60-40 split, where the ownership will reflect that structure. You may have investors purchasing, you may have friends. So again, that's something to consider in terms of whether you want it to be a differing percentage other than the standard 50-50. The next option obviously is considering ownership structure within a non-individual level, which is either a trust, companies, or SMSFs. So again, as Brenda mentioned, there are tax benefits and some concerns or liabilities to consider when you're purchasing, either a company structure, a trust structure, or an SMSF. There's no sort of one size fits all for everyone. You're not going to get that. Each individual, each couple comes with their own unique benefits, and getting a consultation with your accountant and your solicitor when it comes to obviously asset protection structures, you'll only then get your clearer picture in terms of what structure best suits you. And it may be fluid as well. So you may go in initially with a certain structure which may fit a individual structure, but then you get as more sophisticated your property portfolio builds, you may find, well, it's now beneficial for us to transfer it into a family trust structure whereby you can control the distributions of profit and distributions of liabilities. Getting it wrong can be very costly to undo. So you don't want to be switching between structures mid-cycle, because obviously there are transition costs between different structures, whether it will be capital gains tax or stamp duty. So trying to avoid that very early on is key. Getting the right advice at the beginning will also avoid you, paying an arm and a leg midway through the transaction. Once you've determined your structure, you've got your contract reviewed, you're then in the position to obviously do your inspections. So as I mentioned before, the term caveat emptor applies, let the buyer beware. So at this point, you want to make sure that you do your inspections, your pre-purchase inspections, they're called. When you're purchasing a residential property, a house or a townhouse, we recommend that you do get a building and pest report. Now, the report is usually prepared by a qualified builder. They will provide you with a report on the present condition and state of repair. It's only a visual inspection. They can be quite limited in terms of the detail they do provide you, but my thinking is you're better off getting a report done than not having one. So the inspector will look at common visual issues with the building, whether there will be cracking in walls, some safety hazards. The inspector may detect some live termites or concealed damage, which may be evident on the surface. And it's better to get these items checked off quite early, because again, they could be costly. We have clients who do reports, and reports come back to say, well, there is evidence of water penetration under the subfloor. And that could be an instance of a failed waterproofing membrane, which may mean obviously incidental costs of repairing the bathroom, tearing out your tiles, re-waterproofing, placing subfloor timbers. So the costs can be quite significant. So getting the inspections done from the outset will give you a clearer picture in terms of the condition of the property. If you're purchasing within a strata scheme, whether it be a unit, townhouse, we do recommend that you get what's called a strata inspection report. Now, the Strata Inspection Report looks at the financial health of the Earnest Corporation. They'll look at what levies you're paying, the history of special levies, what balances they have in their funds. So they look at, whether they have healthy balances in the administrative fund to pay for your day-to-day expenses of the complex, and their balance of what's called the Capital Works Fund, which is sort of your emergency fund for capital works over a certain 10 to 15 year period. Usually most inspection reports will have what's called a Capital Works Fund plan, which is a 10 to 15 year plan, and it forecasts the expenses that the strata scheme is expected to incur over a 10 to 15 year period. And we look at what stage they're at in terms of reaching those goals. Do they have enough money in the accounts to be spending some expenses which may come after a few years? Are they in deficit? Why are they in deficit? Are there special levies that need to be raised to cover deficits? Is there a history of building disputes? Is there a buildings defects report in there? What's the nature of the defects? What stage are they in determining that the repairs need to be done? Is it urgent? What sort of costings are we looking at? So you can get a lot of information from a strata inspection report. And in fact, we've actually encouraged clients not to purchase within schemes which either may be faced with unhealthy records, instances of disputes within the scheme, contemplated legal proceedings against developers or builders for defective works, and including past or present building defects. So it's a hot topic at the moment, considering what's happening, with Mascot Towers, Opal Towers, that, there are concerns with the state of building within New South Wales. So getting that report done gives you a very good picture of the financial health of the scheme. There is some recent proposed laws for developers to take out insurance over high-rise buildings. So that's a ever-evolving space. But getting that inspection report done from the outset is very important. So once you've got your finance sort of ready, you've got your contract reviewed, you've got your reports prepared. If everything is fine, you're good ahead now to sign the contract. So the process usually is you sign your contract and you pay a 0.25 non-refundable holding deposit. Now that holding deposit is a chance to give you your 5 business days to decide if you want to proceed or not. Now, depending on the timing of when you make the offer, you may not have done your reports before signing. There may be pressure from the agent to sign. There may be urgency in terms of getting this property you've been looking for a while and you don't want to wait. You still have that 5 days whereby you can do your reports. If you haven't had a chance to get your contract reviewed by a solicitor, you can get it reviewed during those 5 days. Any changes you want to make to the contract that can be negotiated during that 5-day call-off period, any reports you want to get, and any finance you need formally approved, you can get done within that call-off period. You can extend that call-off period with consent of the owner. So if after the 4th day you're realizing that finance is taking a bit too long, valuations haven't been done, that we can request a formal extension of that call-off period. And as we're finding with finance dragging out a while at the moment, we're getting those pushed out to probably 10 days. So you get all your checks done. That deposit is non-refundable. So if for any reason you decide after the signing of the contract, I don't want this property anymore, you can what's called rescind your contract, but you will lose your 0.25% holding deposit. If after the 5 or 10 day period, you've got your finance sorted, your reports are fine, then you can call off and pay your balance as a deposit. Now, there is no call off period if you end up purchasing at auction, or if the property is passed in at auction, but you do purchase on the same day. So other than auction scenarios, there is a 5 or 10 day call off period, depending on how you negotiate your contract. So making sure that during that call off period, you've got all your checks done, you're happy with the property in its condition, you've got your finance formally approved, your solicitors reviewed your contract, you can now go ahead and pay your deposit. Once you've signed your deposit, and hopefully before then, you've then considered, obviously, am I available? First of all, am I a first-time owner? Am I available for obviously any first-time benefits? I'm not going to go into too much detail in terms of what benefits are available, but I've listed some benefits on the screen at the moment. You have your $10,000 first-time owner grant, which is available for only new properties for up to $600,000, or house and land packages of up to $750,000. You've got your stamp duty exemption, which is applicable for new and existing properties up to $650,000, with a concession up to $800,000. You've got your first home guarantee, which is a scheme of a 5% deposit scheme for first home owners with at least a 5% deposit, with an option to avoid paying mortgage insurance. That scheme is administered by the lenders or through the lenders. They release, I think, about 10,000 places per financial year. And also you've got your family home guarantee, which is available for single parents with at least one dependent child to purchase a home with at least, sorry, that's an error. It should be a 2% deposit without paying mortgage insurance. So there are available, and obviously the state government has come out to say that they're bringing in a property levy rather than paying a stamp duty. It's not legislated at the moment. As soon as that comes in, obviously that would give relief to some first home owners within that 850 to plus range, and especially those above 800 who wish to purchase a property rather than paying a stamp duty lump sum. They get the option of paying a yearly annual levy. So that scheme has been announced, hasn't been legislated yet, so that's expected to be passed sort of hopefully before the end of the year. Next step obviously is getting ready for settlement. So contracts called off, you've paid your balance. We work with you together with your finance broker to make sure that your loan documents are signed. You've completed any stamp duty exemption forms, and we need to then arrange your settlement, coordinate in terms of what balance of price you've got to pay, and sort of making sure that we work towards settlement, making sure that all the checks are done, the searches are done, your finance documents are signed. We coordinate within PEXA scheme, which is the platform where settlements happen, to make sure that all parties are invited into the system. Everyone's done their part to make sure that we work towards a settlement date. Preparing your settlement sheet, making sure that we work out obviously your share of liabilities for council, water rates, making sure that there's nothing owing, land tax, council, water. We prepare a settlement sheet, and then we'll make sure we work out what your contribution is going to be and how we fund your purchase within the space. Prior to settlement, obviously, then you'll do your final inspection. So the purpose of the final inspection is to make sure that the owner's vacated, they've moved all their belongings out of the property, and the property's in some sort of reasonable condition to what it was left in at the time of purchase. There can be a lot of problems with final inspections in terms of items being left behind, items that are being damaged. So we work with the purchaser, with the solicitor for the owner and the agent, to make sure obviously that whatever is left behind, that gets removed from settlement. If there's any issues in terms of items that are not working, then we can raise those with the owner to determine, why they're not working and what sort of condition were they at the beginning when you purchased. So that usually happens 1 to 2 days before settlement. We make sure that you've done your inspection, you're reasonably happy with the condition of the property, so that we can then proceed to settlement. And obviously, the day that everyone is waiting for is obviously the settlement date. This is when money changes hands, property gets transferred. 9 times out of 10, well, like I said, 99% in our case, everything goes smoothly. There's no issues. We've prepared for settlement. The clients are happy and ready to settle. They'll then get a notification from us once settlement is taking place. We'll organise with the agent to collect the keys, and obviously happy days. You move in, pop your champagne, connect your electricity, your gas, your water, and obviously everything then is done. So that's pretty much it. I know it's a quick rundown. Not here to spend too much time on obviously the process. A brief rundown of obviously how the process transacts, the part that we play in obviously getting the transaction done as seamless as possible. We try to make sure the process is enjoyable, as frustrating as nerve-wracking it can be, especially for first home owners. They come to us petrified at the beginning. So we make it a job to make sure that the clients are well informed along the way. They actively participate in the process. We explain the process to them from the beginning. Any questions get answered. They're involved in the process rather than being left behind. There's constant communication, so that they leave the process at the end sort of enjoying the process, rather than dreading the call from your lawyer to say, look, we need to do X, Y, and Z, or there's a problem here. We can't avoid problems, but being prepared is probably your best ammunition to avoid any of those issues happening sort of down the track. That's about it, I guess, in terms of what I wanted to say today. Anyone have any questions? Let me see if I can bring
Hi,
up.
Richard.
Hi, Brenda.
Yeah, that's brilliant. Yeah, thank you so much. Yeah, for the information. I actually I have a question. I already know the answer, but I just want to ask for the benefit of the attendees. So if anyone wants to change the ownership, so husband-wife team, if they don't want to share the property 50-50, they have to change it to as so instead of joint tenant, they have to use tenants in common. That's right?
Yeah, so you can sever the tenancy. It's called severing a tenancy. So you can apply. It's a form that we fill out where we have to sever the joint tenancy so that you don't own it as tenants in common, or joint tenants you now own it as tenants in common.
Oh, okay. So if it's joint tenant, there's no choice. For tax purpose, it's 50-50. Yeah, you know the the legal ownership. So if
so it's for
anyone,
tax purposes it's the same.
Yeah.
But we do have couples who want obviously changing the ownership structure, whether it would be property solely in the husband's name or solely in the wife's name, and they say, look, we don't want to transfer half to the spouse for tax purposes. Well, as I mentioned to you earlier, there are exemptions available for owner occupied, not for investments. So if in investing property, they want to sort of change the ownership structure, there are some implications from a stamp duty point of view to get that done. But it does happen. And getting that advice early on sort of avoids those costs down the track. Yeah, that's right. Or I guess more with the understanding on the benefits. Yeah, because sometimes it happens if you change, say, 30% of the ownership, maybe 30% from husband to wife name, but then down the track, when you have a calculation, you're actually saving more tax in the next future years. Then the so you have
cost.
to work out the cost benefit analysis of what it's costing in stamp duty and potentially the tax benefits that you can get. Yeah, then it will still be worthwhile, or change it to a family trust structure. Yeah. All right, that's my question. Yeah, thank you so much. Okay. Anyone else? I've lost the chat box. I can't even see it. I can't see any questions. No questions. Yeah. Do anyone have any questions for me, like for either of us at the very end before we finish? Oh, Lee Tad, you can contact me later on. Yeah, on your question about Lee Tai. Yeah, on the CGT exemption. Yeah, is that okay? All right, that's cool. In that case, thank you, Richard. Thank you so much for the information. Oh, we got a new message. Let's have a look. What is the cost of changing ownership? Okay, Anna, that's a good question. Yeah, so I guess on top of legal costs, so you need to pay a conveyancer to do the job, the legal change. Of course, you pay stamp duty, you pay capital gains tax. So capital gains tax is actually calculated on the part of the change. So it depends on the, when you're changing the property, let's say if it's worth $1 million on the market, then you change say 10% of the property from husband to wife, then that's going to be 100K. Does that make sense? 100K of that value. Then of course 1/10 we also need to have a look at the cost base. So it's like a capital gains tax calculation, and plus the discount. Then based on your marginal tax rate, we can calculate how much tax you have to pay. So that's on the capital gains tax. Stamp duty is also on that portion you're changing hands. Does that help to answer your question, Anna? So unfortunately, it's not a simple answer. It depends on the value of the property and the portion you have to change. Does that help to answer your question? Yeah, so we can always help you to with the calculation. Yeah, all right, that's cool. Any other questions? If not, then we'll stop this session. Thank you everyone for attending. Oh, thank you, Olivia. Yeah, thank you for your kind words. Yeah, okay, thank you everyone. So anyone, if you want to have a PowerPoint presentation or the PowerPoint we did, send me or Richard an email, or send me an email, then I'll let Richard know. Then we'll pass you a copy of the slides.
All right, and then we'll also upload the recording on our YouTube channel. Then once it's uploaded, I'll send everyone an email with a link so that you can come back and watch it again. Yeah, if you want to. All right, that's cool. Thank you. Thank you, everyone. Let me
Thanks,
stop the
Brenda.
recording. Thank you, Richard. Thank you so
Speak
much.
soon.
All right. Let me...
Thank you.
Thank you, everyone. Let me stop the recording now, if I can find the button.